Welcome to Taxes Made Simple Live. I am so happy to be here with you guys. Man, what an incredible year we have been on. At the start of this year, I started this YouTube channel. We grew it to over 200,000 subscribers. I see the room filling up, and I'm excited to be here with you guys. Today, I'm going to go over some year-end tax strategies that I feel like are important for you guys to know. And part of the reason why I'm going to cover year-end tax strategies is because there are a lot of CPAs that are meeting with their taxpayers right now, and they're not providing them the advanced tax strategies to help them reduce their tax bill. So I want to get on here, guys. I want to give you some of those advanced tax strategies that you're looking for, those tax strategies that are actually going to bring down your tax bill. I also want to debunk some myths that are coming up in some of the calls that I'm having personally. I've been recently taking on a few consultations, as I always do right at the end of the year, and I'm hearing a lot of confusion when it comes to this whole S-corp thing. You guys know I talk about S-corps a lot on my channel. I want to make sure everyone knows when to switch over to an S-corporation, but I also want to make sure that you guys know how to switch over to an S-corporation, even if your CPA tells you that it's too late. Now, to give you guys a little background of who I am to anyone who's just coming onto this channel, my name is Karlton. I'm a licensed enrolled agent. I hold the highest designation that the IRS allows for tax providers. And part of the reason why I created this channel is because I noticed that there is a lack of tax information online, and the tax information that is online is very confusing to understand. When I came into this whole tax world, I did not have an accounting background. I did not go to school for accounting. So when I studied tax, someone had to teach it to me like a fourth grader. And when I learned real estate tax law and business tax law, I figured out how to turn around and teach it to other people as if they were 5th, 6th, or 7th graders. That's how taxes really should be explained, because we're not learning it in 5th, 6th, and 7th grade, are we? So when it comes to this channel, my goal is to give you the information that you're looking for, broken down in a simple format, just given right to you, no fluff, just so you have what you're looking for. Now, before we jump into the lesson that I have for today, I just want to make sure you guys are fully aware of the difference between tax preparation and tax planning. Because you might be going to your CPA or to your tax provider, even to your enrolled agent, and they may not offer tax planning yet. I do not want you to place too much blame on that accountant. Maybe they don't focus on tax planning. Maybe they just do tax compliance. Right around this time of the year is when I get a lot of conversations coming over from taxpayers telling me, Karlton, why does it feel like my CPA never comes to me with creative ideas on things that we can be saving? Why do I have to forward your YouTube videos to my CPA and then they turn around and tell me, oh yeah, we can do that? I personally don't think that that's how it should be. But if you have a good understanding of the difference between tax compliance and tax planning, you'll understand why some of these certified public accountants or even enrolled agents aren't really providing you with that tax support that you're looking for. Most CPAs, most tax preparers have been trained to gather your information in preparation for tax season. When it comes to consulting with you to figure out ways to help you reduce your tax bill, they don't spend time doing that because that's not what they're doing throughout the year. They spend most of their time throughout the year doing actual physical work. Whereas professionals like myself, I rarely even touch tax returns. I spend a majority of my time on the conversations with people like you guys, business owners who are making income in all abstract types of ways. Day traders, truck drivers, real estate investors, wholesalers, flippers, YouTubers. I need to be able to understand your businesses, how you make your income, how you live your lifestyle, and then use the tax code that I've studied year after year, and then match it to your lifestyle so you have tax savings that you can understand. But when you go into your CPA's office, I want you to be able to go to him or her for what their job is for: tax compliance, filing your tax return. Now, there's been a lot of lack of support from CPAs, from tax preparers, and I never want to shoot down CPAs or tax preparers because I understand the difference between tax planning and tax prep. And I know you guys understand the difference between tax planning and tax prep. But I recently got off the phone with a client yesterday who is now a client that had a conversation with his CPA, and he was looking for genuine tax help. He had watched my YouTube videos. He had set up his LLC a year prior, and he knew it was probably time for him to make an S election. The reason why was because he had over $750,000 in net income. That's after all expenses. So he knew that he was going to have a big tax bill after watching my YouTube videos. He learned about self-employment tax. For anyone who's new to this channel, self-employment tax is 15.3%. That's Social Security and Medicare, but you pay it on all of your business's income. So I quickly did the math. I pulled out my calculator and I did 750,000 times 15.3%. And I got $114,750. This immediately became a $100,000 conversation. Let me explain why. His CPAs that he had just gotten off the phone with, that he pays a pretty penny to monthly, by the way, had told him that he had done everything that he could possibly do to reduce his tax bill. The month was December, and he had watched my YouTube video about switching over to an S-corp. He showed his CPAs my YouTube video, and they told him that it was too late for him to switch to an S-corp, that he was past the deadline for making a subchapter S election. For any of you guys are aware, there is rules in regards to switching your LLC or your C-corp over to an S-corp. And the rule is that you have to switch within 2 months and 15 days of the beginning of the year, or 2 months and 15 days from you setting up your entity. Well, we're in the month of December. We're clearly past 2 months and 15 days. And the CPAs were just informing him of the rule that they had learned as being certified public accountants. You see, as a tax strategist, I study tax law and I study publications. And one of the IRS's publications is Rev Proc Procedure 2012-30. Rev Proc Procedure 2012-30 is late subchapter S relief for taxpayers. Well, Karlton, what does that mean? Well, what it means is if I have a taxpayer who's late on filing their S election, that there is a way in which we can get relief and file a late S election. How this is done is by having a reasonable cause for filing your S election late. It was fair to say that my customer had a reasonable cause for filing his S election late. His CPAs never notified him. He didn't even find out about my YouTube video until probably July, August. So there was negligence. He did not know that he needed to switch over to an S-corp. He did not know the benefits outweigh the cost for him to switch from an LLC to an S-corporation. But after talking with me, I educated him over this RevProc procedure. And I notified him that he has actually 3 years and 75 days from the moment his LLC has been established or his corporation to make a subchapter S election. I can feel across the phone that he was finding some hope. I could just sense it. I wasn't looking at him face to face, so I could feel it. And I just told him, you would save about $114,750 just by making an S election. He was baffled. He's like, so you mean to tell me that my CPAs didn't tell me that I could do this? And I'm like, hey, listen, I'm here to deliver information, not emotions. You have a way to file a late S election. Now, completing a RevProc 2012-30 form has to be done electronically with the tax return. So if we're filing your tax return come March 15th, when S corporations are supposed to file their tax returns, then I am going to have the RevProc form on top of your 1120S tax returns, and I will file you as an S-corp. Let's just say you have submitted subchapter S election documentation already ahead of time, and you got a denial letter. You got a letter in the mail saying you've been denied of being an S-corp. Does that mean that we can't do this RevProc procedure? Does that mean all hope is lost? Absolutely not. You see, my client, who is now my client, I talked to him yesterday. He had already gone around his CPAs to do the 2553 form, the form that you can fill out to transition over to an S-corp, and he received a denial letter from the IRS. Then he called me and scheduled the appointment. Karlton, is there anything I can do? Enter walks the Red Proc 2012-30 form. Enters in $114,000 in tax savings. Guys, if you're watching this video, you might be one of my taxpayers that's sitting there at the end of the year, scratching your head like, how am I going to come up with this tax bill? Why do I feel like there's nothing left for me to do? The truth of the matter is there's always something that you can do. And to be completely honest, I look at an S-corp like putting a Band-Aid over the wound. You are already going to pay taxes, brother. I'm just putting you into the right vehicle. I'm just putting the Band-Aid over the wound. You are already bleeding. Okay? Now, if you would like for me to perform surgery, come into my office and let's put together a whole tax plan. You see, when I talk to this taxpayer, guys, and we'll jump into the iPad today, so this will be a fun, engaging conversation. When I talked to this taxpayer, I told you he had $750,000 in net income. He was already trying to do his own tax strategies. He was like, hey, I'm not going to write a check to the government. I even seen my parents who own their businesses write a check. I don't want to be like them. I want to be smarter. I want to be savvier. There has to be something I can do. I see other business owners who don't write checks. Maybe I can just spend the money. So that's what he did. He had the idea as a business owner that he was just going to spend the money to avoid taxes. Maybe that could be strategic, maybe not. But what his strategic idea was he was going to use a vehicle. Now, keep in mind, he had $750,000 taxable income. He was going to purchase a vehicle to try to offset his tax burden, okay? The vehicle that he was going to purchase was a Rolls-Royce Cullinan. Guys, any of you guys know how much a Rolls-Royce Cullinan is? A Rolls-Royce Cullinan is $600,000. Now, in order for him to get this $600,000 deduction, he has to leverage some type of tax strategy. In his mind, he was thinking, I can do a 179 IRC vehicle deduction underneath on this Rolls-Royce Cullinan. By leveraging code section 179 plus bonus depreciation, this taxpayer can write off the entire vehicle's purchase price against his business's taxable income all in 1 year. He would reduce his tax liability down to $150,000 taxable income. Keep in mind, though, he would have to go and buy this Rolls-Royce Cullinan. My taxpayer, he was a young taxpayer, he's only 22 years old. He was in a position where he was making millions. This is his second year making millions. He hadn't spent any money on luxuries yet. This would be probably the biggest purchase that he would ever have in his life. At 22 years old, he'd be spending money on a Rolls-Royce Cullinan just to avoid taxes, dropping $600,000 on a car to avoid taxes. But in the conversation, he found out he saved $114,000 just by switching over to an S corporation. His down payment on that Rolls Royce might have been $114,000, a business income that he would have to give up just to buy the car. Yes, you're getting the tax deduction, but it doesn't mean it doesn't mean you're not spending money to get the deduction. Okay? One of the cool things about the 179 vehicle deduction is if you finance the vehicle, which means you're putting a down payment down, I can still write off the entire purchase price. So he's winning there. But maybe you didn't want to spend money on one of these luxuries just to reduce your tax. That's when tax planning starts to factor in. I have enjoyed working with many S corporation owners because once you transition over into the S corp, there's about 260 strategies that we can leverage outside of you needing to buy cars to reduce your tax bill. I personally didn't want him to be in a position where he had to go and buy that car. I want him to be in a position where you can buy it if you want to buy it. But I want to show you how to leverage the tax code to the fullest extent before going down to the dealership and making an investment that maybe you don't have to make. Okay? So this taxpayer onboarded, and we're going to go ahead and move him over to a subchapter S. We're going to take a payroll deduction before December 31st with the 16 days we have left in the year. And I'm going to run the other 260 strategies that I have in my wheelhouse to offset his taxable income. And I'm going to do it within the tax code. and I'm going to show him how to leverage it. And he's going to feel confident when it comes time to file his tax returns because he's been educated first and then he got the tax savings second. And that should be the order of operations. Education first, tax savings second. I should know what I'm doing before I do it. Now, I focus primarily on teaching business owners who are doing anywhere between 2 to 100 million how to invest in real estate to avoid taxes legally. I work with a lot of clients, a lot of taxpayers who have high W-2 income, they have high 1099 income, they're investing in crypto, they're doing day trading. All of this is taxable income to my taxpayers. Okay? I'm now in a position where I am spending a majority of my time educating business owners, not just on business tax strategies and on business write-offs. There's only so many of those. I'm educating them on how to leverage rental real estate. Rental real estate is a tool that business owners can use to avoid taxes legally. How does that work? Well, just like my customer was writing off his car that would have cost him $600,000 that he would have written off all in 1 year, you and I as taxpayers can choose to write off rental real estate and some of the components of rental real estate in 1 year too. So let's talk a little bit more about that. As a taxpayer, I learned the hard way that there are some rules when it comes to leveraging losses. And what I mean by that is when you invest in rental real estate is one of the only businesses that on paper, you can look like you're not making any cash, which means you're at a loss, right? You're not positive on paper, but then you're cash flow positive, which means I have rental income coming in, but I have these expenses, and these expenses are outweighing my rental income, but I'm still cash flowing. How is that possible? Well, depreciation makes it possible. When you decide to buy an investment property and you place this property into business purpose, which means you have a tenant with a signed leasing agreement, you have activated a very important thing. That important item that you've activated is called depreciation. And the government gives you and I, taxpayers, a write-off for the entire building's value. Whether you purchased the entire building or not, just like whether you purchased that entire car, that Cullinan or not, I can write off the entire building's value. That's the most important L word I like to use, leverage, right? Okay. So I can leverage OPM. I can use the bank's money, go and buy one of these, and everything that makes up this house becomes a write-off. How does that help me reduce my taxes, though? Well, let's talk some numbers. It's easier when we're talking numbers. If I'm a W-2 taxpayer, maybe who's working at Google and came into some RSUs, everybody's getting these RSUs lately, and they're vesting, I might go from being a W-2 employee that's earning $300,000 a year on my W-2 salary to now being in my first seven-figure year making $1 million. And I might be a W-2 taxpayer that, just got married, and me and my wife are having our first child, and we're trying to build wealth strategically. I want to make sure that my children have college savings going for them. I don't want to stress on that end. I'm making all this money this year with my RSUs vesting. I don't want all of it to go to the government. I want to be protected. That's this type of taxpayer, right? Now, one of the things that we have to understand is that the government has created rules as it pertains to using losses from rental real estate. It's called the passive activity loss rules. And as a taxpayer, you can Google these. The long PDF document that'll go over all of the passive activity loss rules. But one of the rules states that if we're a taxpayer, in order to use our losses, we have to follow these two rules. Either one, our AGI is less than $150,000, Or two, we qualify as real estate professionals. Okay. Now, most taxpayers I talk to, their AGI is well over 150,000. If you're on this live chat and your AGI is less than 150,000, you're able to use some of your losses that come from rental real estate, but you're capped to only 25,000 if you make less than 100,000. And as you make over 100,000, it starts to phase out all the way up to 150. After 150,000 AGI, you do not receive any losses that can work against your W-2 income, your 1099 income, your crypto income, unless you qualify as a real estate professional. Okay? So real estate professionals are able to use 100% of their rental losses against active forms of income. Let me explain how this works. If I had that $1 million W-2 income and I invested in a rental property, and this rental property, let's just say, was $2 million, and I was able to get a closing statement from the property that showed me online that my building's allocation for this property was 1 million and my land allocation was 1 million. Okay? So 1 million was the building and 1 million was the land. Hence my $2 million property. Well, as a taxpayer, I want you to learn something today. When you decide to buy rental real estate, your investment, the government is only going to give you a write-off for one of these items that you have bought. They're going to give you a write-off for only the building, not the land. Here's the reason why. Guys, the land was here before you and I were here, okay? Someone got smart enough and just said, let's just build on top of this land. The land does not go up and down in value from a depreciation standpoint with the IRS. It can go up and down in value when you get ready to sell your property from a property standpoint, but from an IRS standpoint, it is not recognized on the tax return, okay? So you need to know what your building's value is, less the land that it sits on, because we only get a write-off for the building. Now, let's say our building's 1 million. This 1 million, we're taking as a write-off over the course of 27.5 years if you and I have decided to buy a residential rental property, okay? Residential rental property, 4 units or less, 80% of the time is being used as a dwelling unit, meaning someone is sleeping there at least 80% of the time. That classifies our property as residential. That means this 1 million will be divided over the course of 27.5 years, okay? So that's going to give us about 36,363 as a tax deduction year over year over year. That is a really nice tax deduction to be receiving for a really long time. Many savvy taxpayers, like you and I, we are looking for ways to leverage. L word, leverage, is one of the most important words in business. And if I can leverage my investments to offset other forms of income, time value of money, TMV, tells me that I have the ability to reproduce, create more money right now due to inflation and the cost of living going up. Having more tax savings, having more access to more of my own money, can reinvest my money, grow my business to make more money faster, knowing that the cost of living is going to continue to rise. Now, most savvy taxpayers, like I said, we're going to accelerate depreciation, just like how my taxpayer was going to buy that Rolls-Royce Cullinan and do the 179 plus bonus depreciation to write the entire vehicle's purchase price off in 1 year. As a taxpayer, we can do what's called a cost segregation study. What a cost segregation study is where a tax preparer and an engineer, like a company like mine, we go to your property and we are taking photos of the property because we need to perform a study on the property. The reason why we need to perform a study on the property is because I want to get all the components that make up your property. I want to get your refrigerators, I want to get your cabinets, your flooring, your sinks, your appliances, your microwave, your drywall, your windows. And I want to get a cost associated with all these components that make up your property. Because what I'm going to do, just like how my taxpayer was going to write off that Cullinan in 1 year, I'm going to write off all those components in 1 year. The washer, the dryer, the appliances, anything I can identify that has useful life of 15 years or less, that does not last 27 and a half years. Taxpayer, you and I both know cabinets, flooring, appliances do not last 27 and a half years. Then we can segregate them and we can write them off on a quicker depreciation schedule. Now, taxpayer, I want you to know something. We're leveraging 1 million over here in building value. That's all we got with this property. But if we're using this 1 million and doing a cost segregation study, then we are going to be able to write off, on average, about 40% of our acquisition cost, the building's value, in 1 year. So from the building's value, 400,000 can be taken as accelerated depreciation. Let's just say on average, okay? Part of the reason why we're not going to be able to write off the entire building in 1 year, the entire property in 1 year, is because there are structural components that have to remain in the building's 27 and a half year life. Guys, if you ever go through a neighborhood that's just being built, what do you see? You see the wood, right? You just see the wood of the house, right? The structure of the house. And then eventually you'll start to see the outside and all the components and the windows and all that other fancy stuff that comes on the outside of the property, the roof and the drywall and the fireplace. But the structural component cannot be accelerated. The structural component will remain in the 27 and a half year life. And that on average is about 50 to 60% of your building's value. So if I have this $400,000 that I accelerated and I qualify as a real estate professional, I can use the $400,000 loss that was created and offset my W-2 income of $1 million plus the RSU income that I have. Now, the next thing we have to learn is, how do we get this $400,000 to offset the 1 million? How do we qualify as a real estate professional? Okay. The government's created rules for real estate professional status. The rules state that in order to qualify as a real estate professional, a taxpayer needs to spend 750 hours in the year materially participating in their real property, trade, or business. Or they need to spend more than half of their time in a real property, trade, or business in which they materially participate. Okay? So there's 2 tests to become a real estate professional. The 2 tests state that I have to spend 750 hours in my real property, trade, or business, or I have to spend half of my time materially participating in my real property, trade, or business. Okay, what is a real property, trade, or business? The government has identified 11 real property, trade, or businesses. Being a real estate agent counts as a real property, trade, or business. Being a broker counts as being a real property, trade, or business. Being a flipper, a wholesaler, being an investor, being a real estate manager, acquiring real estate, developing real estate, redeveloping real estate. These are real property, trade, or businesses that you can run. Most of my investors, though, are going to start a real estate acquisition business first, where they're acquiring real estate, and then they'll choose to manage their real estate. Now, I don't want to turn every taxpayer into a manager of real estate, but if you want to be able to use real estate to offset your W-2 income, your 1099 income, your other forms of income, your crypto, your stock gains, then you will learn a little bit more about this real estate professional status. It's one of the most powerful rules in the IRS tax code. Many taxpayers realize that they cannot spend the half of time that the real estate professional status requires in their real property trader business because they have another job. I would have to show the IRS that I'm spending more time in real estate than I am in any other job I have, than my tax firm, than what I'm doing on YouTube, whatever it might be, that is my real job that I have. And as a W 2 taxpayer, it is far too hard to spend more than 40 hours in your working week in your real property trader business. Now, many taxpayers, like I said, can qualify for real estate professional status, but they can qualify by using their spouse. How you can do this is by having your husband or your wife, who may be not as active in a business or not as active in a job, manage the real estate portfolio. If you have a spouse that is managing the real estate portfolio, your spouse can show that they're spending half of the time in the real property trader business, and your spouse can qualify for the 750 hours for real estate professional status. The 750-hour test taxpayers comes out to about 13 hours a week. For a taxpayer who has a spouse that might be taking care of a newborn, or maybe your business is just getting off the ground and you have a wife that's working in the business, but maybe she's not as active in the business, or a husband who's not as active in the business. This is an opportunity where we can leverage a taxpayer that we file tax returns with to qualify as the real estate professional on the tax return. Now, by doing this, that $1 million that we had in taxable income can now be offset with the $400,000 in losses. And now we've dropped our taxable income to $600,000. Now you might be saying, okay, we're still paying taxes though here. The customer has $600,000 in taxable income. You can see though, that if we just implement another investment property, that we're creating additional losses that can work against this income. What if this taxpayer would have purchased another investment property and did a cost segregation on another property? And maybe the cost segregation on the next property gave him an additional $600,000 in losses. Taxpayer, you can be tax-free by leveraging rental real estate. Taxpayer, you can earn 7 figures and not pay any taxes on the 7 figures that you're earning. Now, I know it may seem like a lot on this call today, but I have taxpayers who are investing in rental real estate, accelerating depreciation, and avoiding 100% of their taxes. I have clients that have done this over and over and over again. And I will never forget when I learned about real estate professional status. I was 23 years old, working in my mother's office as a tax accountant. At this time, I was selling tax plans. I wasn't even really inside of the tax plans yet. And what happened was I had a taxpayer who came into my office that was a real estate investor. This taxpayer came into my office. I looked at his tax returns and he was sitting on 15 rental properties. He was making north of about $2 to $3 million, and he had a 0% tax liability. The taxpayer, I asked him how his day was going, and he instructed me on telling him, hey, what day is it in the week? I said, it's Tuesday. He said, okay, sorry, I get all of my days confused now. I haven't done anything in a while, and I just kind of lose track of my days. I was sitting there across from a taxpayer who had been making $2 to $3 million yearly off of his rental real estate, had a business, wasn't paying any taxes, and barely knew what day of the week it was. He had been doing this real estate game so long that I could see how many properties that he had done cost segregation studies on, how much depreciation he's accelerated, how many 1031 exchanges he's done. He was at a point where he was never going to pay taxes. And if he had just continued to do exactly what he had done, he'd probably never pay taxes ever. He was very savvy. He had a trust, which means that his children would eventually get those properties if something were to happen to him. It wouldn't go to the banks. The children wouldn't have to deal with probate. And the children would get the step up in basis when he died, which means that they get the property with no debt on the deal. They can sell the property and net no capital gains tax. And this was the moment that I went heavy into real estate. It was the moment that I had my wife join my company. It was the moment that I started going super hard into getting my wife to manage our real estate portfolio. You see, my wife qualifies as a real estate professional on our tax returns. I can't show that more than half of my time is in real estate right now. I'm doing too many things at my firm. And you might be a taxpayer that's doing a lot inside of your corporation, inside of your business, or you're working a W-2 job. So one of the things that we have to look at is how can we eventually get to a place of leveraging real estate professional status? Does that mean that we should start acquiring Cullinans? Or should we possibly start acquiring real estate knowing that eventually we'll qualify as real estate professionals? And maybe that's something that you might want to do, is develop a strategy on how you can start investing in rental real estate and then eventually be coming to a place where you can utilize your losses. Now, I have one other strategy for my W-2 taxpayers who are on here that do not qualify for real estate professional status. And I want to give this to you, and then I'm going to share with you where you can learn more about this after today's session. So as a W-2 taxpayer early on, I did not qualify as a real estate professional. I wasn't married yet when I got my first rental property, which means I didn't have a wife on my tax return who could qualify as a real estate professional. So we both can enjoy rental losses against my W-2 income, against her W-2 income. We weren't there yet, okay? But I learned that underneath the passive activity rules, Code Section 469, in case you want to look up the code section, that short-term rental real estate is treated differently. As a matter of fact, short-term real estate is not considered a rental activity underneath the Section 469 passive activity loss rules. What that means is, in order for me to use my losses with a short-term rental property, I don't need to be a real estate professional, and I don't need to spend 750 hours in the year. Leveraging short-term real estate just requires material participation. And as a taxpayer, I learned that a material participation is a 7-part test. The cool thing with material participation is that you only need to pass one test to qualify for material participation. Wow. All right. Well, let's go over what the tests are. Which tests do I need to pass, Karlton? How am I going to be able to use real estate to offset my W-2, my crypto, my 1099 income? This one test is spending 100 hours or more than any other person in your real property, trade, or business. What does this mean? Well, rather than spending 750 hours, rather than having to spend half of my time in a real property trade or business, more than my W-2 job, all I need to do as a taxpayer is spend 100 hours managing my short-term rental property and more than any other person in the tax year to materially participate in my short-term rental status to use my rental losses. Okay? Now, being in your property 100 hours, that's easy. Okay, that comes out to about 90 minutes a week. That's very doable. Managing your property more than any other person is where you need to be smart. There's tons of Airbnb companies that will run the Airbnbs for you. If you're letting someone else run your Airbnbs for you, you're not managing your Airbnbs, are you? I would need to, in an IRS audit, see a time log of you showing me the time that you spend managing your property, plus the time that your manager spent managing the property too, so that I can compare who actually managed the property more in this year. Does my taxpayer qualify for material participation? So underneath an IRS audit, how we would win, if we ever got audited, because that's the approach we want to take. Let's just say we're getting audited. How would we ever win this? Is we would need a logbook. The logbook would need to have some items on it. The logbook would need to have the date, the time, and the activity in chronological order of what we were doing that totaled to 100 hours that qualified us for material participation. Okay. So as a taxpayer, you come to my office, we give out these logbooks because we work with a lot of business owners. We're teaching business owners real estate, real estate, real estate, rather than just tying up money into 401ks, defined benefit plans, set plans, where we don't know what the tax liability is going to look like later when you're 59 and a half, right? I just want you to have more control as a taxpayer. Real estate gives you control. We can go touch a rental property, right? We can pull money out of a rental property. We can accelerate depreciation on a rental property. We can use passive activity losses from real estate, right? And if we leverage short term, whether we're W-2, 1099, we only have to put in 100 hours and make sure that we're managing that property more than any other person. So let me give you guys a situation to put some realness to this. Today's December 14th. December 3rd, I had a phone call with a taxpayer. I knew that this taxpayer was looking for a big way to reduce his tax bill. I told him, hey, if you want a creative strategy, I have one for you. Turn that property that you have into a short-term rental right now. He said, why? Because I said, I need average customer use days of 7 days or less to be able to claim that property as a short-term rental property. I need you to show that you're spending 100 hours managing it in order for me to use material participation for the end of the year. He said, why would we do that? I said, because I'm going to do a cost segregation study on it. I'm going to accelerate depreciation on that property, and I'm going to help you offset your business's income. Rather than you having to do a 179, rather than you having to tie up this money into a retirement account, I'm going to help you use what you already have spent your money on and accelerate depreciation, and we're going to avoid taxes this year. With the tax savings that you receive as a taxpayer, you can do whatever you want with that. You can parlay it back into another investment property and play the game with me. You can reinvest it back into your business, grow your funds of the business. Then we have a bigger tax problem, right? But we got to figure that out. At the end of the day, you will need another tax plan, because if we accelerate depreciation on your first property, what's going to happen in the following year? Your depreciation will start to dwindle, which means that we're always going to need to have a plan. Guys, I've enjoyed going over real estate with you guys today. I've enjoyed going over real estate professional status. I enjoyed going over the short-term rental strategy, because when I learned about this strategy, I realized, man, this is going to be so powerful for any taxpayer if they just understand this. But most importantly, I wanted to make sure that you taxpayers knew about the S-election. The majority of you are business owners sitting on here right now. Majority of you have LLCs. I understand that because I make a lot of LLC videos. And if you're someone that has watched my LLC videos and you know you're over that threshold to switch to an S-corp, you now have a means to do so. You now have tools to help you get there. My job is to continue to support you as you're building your wealth. My job is to continue to give you advanced tax strategies, the ones that you typically don't hear on the internet. You typically don't hear this in your tax office. But if you would like to learn more, feel free to subscribe to the waitlist to my course, Tax Alchemy. It will be dropping December 28th. This course will go over how to invest in rental real estate, how to use the short-term rental strategy, how to use real estate professional status to offset W-2 income, 1099 income, crypto income, stock income, Social Security income, your income. My name is Karlton Dennis. Thank you guys for your time today. I look forward to seeing you guys on the next one.